Each stock in the market displays some characteristics. There are growth stocks or value stocks, there could be momentum stocks or quality. And when somebody looks to stitch them into a portfolio, we usually see that people opt for, any one particular style. But what we're offering in our latest fund, SBI Quant Fund, is a multi-factor approach. And all-weather portfolio, if you could call it that. Hi everyone, I'm Sumera Abdi, and with me I have Sukanya Gosh. She's the fund manager of the SBI Quant Fund, and Dinesh Balachandran, our head of equity at SBI Mutual Fund. So thanks to both of you being here. Dinesh, let me start with you. The question everybody wants to know is what makes this fund so unique? What is this multi-factor approach?
Yeah, thanks for having me. When I think about this fund, there are many aspects that are unique about it, but I will specifically talk about three aspects that I think are quite important. One, when you think about SBI Quant Fund, the framework is inherently objective in nature. It is based on quantitative model / framework. So when you think about a quantitative model versus a subjective discretionary kind of approach, right there is an inherent difference where you have a lot more rigor, you have a lot more defined characteristics. From that perspective, this portfolio will always behave in a different manner compared to any of the normal actively managed funds that are there outside, right? The second aspect is when I think about even within the quant space, there are funds out there, but most of them rely on one or two factors. For example, there might be funds that just rely on a momentum framework, or there are funds that rely only on a quality framework. In our SBI Quant Fund, we essentially have a multi-factor approach where we have four factors which are very different from each other. And all those four factors combine essentially to create a very robust portfolio. I'll let Sukanya explain the details of those factors, but suffice to say that when these factors are put together, it definitely aids the portfolio construction process. The other aspect that's very important is normally people think about these factors in a very static, stagnant fashion, where they assume that all these factors should always have the same weight in portfolio construction. But something that is very cool about this fund is the fact that the weightage that we assign to each factor is inherently dynamic in nature, which means that depending on the market regime or the market environment, we might assign more weightage to a value factor or a quality factor. So that dynamism we've seen, at least in our backtesting, it really helps in terms of construction of a robust portfolio.
So whatever is performing at the moment will naturally be in favor in the portfolio as well.
Yes, until it reaches an extreme, in which case you actually potentially want to sort of bring it down.
Fair enough. Sukanya, so how will this dynamic portfolio be constructed?
So what we basically do first is that in our multi-factor model, we are covering four factors: momentum, value, quality, and growth. And every stock in our universe, we give a momentum rank, a quality rank, and a value and growth rank. Right. So for each stock, you get one rank, and then we are combining all those four ranks to come up with a quant rank. Now, as I mentioned, there is this dynamic allocation that's happening. So we look at the factor performance of these four factors month on month, and we see whichever factor is performing, we tilt the weightage towards those factors, and we reduce the weightage of factors which are not performing well. And so that leads to a quant score. The quant score is the sole deciding factor of what comes into the portfolio and how the portfolio gets constructed. The last leg is that we have tried to make it as liquid as possible, and as risk constraints have been introduced so that there is no excessive concentration towards a stock or a sector. So we have some tracking error limits, turnover limits, sector and stock limits, liquidity limits, which finally lead to the construction process.
Okay. So if I understand it correctly, the quant score will have all the four factors as a parameter, and every stock will be graded, and then the quant score rates the stocks. Yeah. Okay. But Bala, these factors, typically they'll play out over years, right? I mean, value may be in favor for say 1 year, 2 years, 3 years, and maybe even longer cycles. So how often is this fund going to be balanced? I mean, I heard Sukanya say that monthly they are going to look at what is happening. Right. Is it going to be, for such long cycles, do you still need monthly rebalancing?
Right.
What's the
So
idea?
what we've seen is that there are certain styles / factors which are very stable. For example, when you think about quality of a business, that is not going to change on a monthly basis, right? So that is a very stable factor. On the other hand, when you think about momentum or when you even think about value, because price plays an important role in these factors, price changes regularly. Basically, every day the price of a stock changes, right? And from that perspective, these factors are inherently a bit more dynamic in nature. Even when we think about the earnings factor, the fact is that companies positively surprise or negatively surprise on a quarterly basis when they announce the results. So the earnings factor also changes depending on whether the company is doing better than expected or worse than expected. So when you put all these factors together, what we've seen is that even on a monthly basis, the relative ranks of stocks, they do change. And when we did our backtesting, we found that a monthly frequency is probably appropriate in terms of thinking about when to rebalance the portfolio. But mind you, there are two aspects to this portfolio construction. One is the normal portfolio construction where based on the ranking of various stocks, you are constructing a portfolio. The other aspect, which is this dynamic rebalancing, that is very infrequent in nature. You're right that normally what we've seen is that when quality is in vogue, it tends to be in vogue for years. You don't measure it in days, you measure it in years. Similarly, over the last 4 years, we've seen value as a factor has done extremely well. It hasn't been a monthly phenomenon or even a quarterly phenomenon. It's been much more than that, right? So the dynamic rebalancing that we are talking about, that tends to be very infrequent in nature. That tends to happen on average maybe once every 3 years or so. So for example, when I think about the previous round of dynamic rebalancing and the latest that happened in April of this year, it's been a time span of roughly 3 to 4 years essentially. So that aspect is less frequent, but the normal so-called rebalancing where you're trying to rank stocks all the time, that we've seen that monthly rebalancing definitely helps us compared to a less frequent rebalancing.
So, under the larger umbrella of a style, which is value or growth,
Right.
you have a bottoms up approach which requires regular monitoring.
Exactly.
Okay. Sukanya, any risk factors that investors need to be aware of?
I mean, after all, it's an equity fund, so it will be volatile like any other. When the markets are volatile, this fund will also move along with that. But we have tried to keep a lot of risk constraints in so that there isn't excessive risk taken for a fund. But it will, after all, work with the markets.
Okay. And finally, Dinesh, what kind of investors need to look at this? I understand it's an equity fund and therefore falls into the very high risk category, but by its very nature it becomes an all weather fund, right? Because irrespective of what happens, the hope is that the fund will perform.
Yes.
So can everyday sort of investors, anyone look at it?
Right. So I really think of it as a core fund. When you think about the benchmark, we are essentially talking about the BSE 200 benchmark, right? So this fund is inherently a large cap focused funds. It will invest in the top 200 companies of the universe, which means that this fund is not going to be a small cap fund. So anyone who is looking for a small cap fund, this is not the fund for them. But I would argue that a small cap fund should not necessarily be a core fund for most investors, right? There you normally make them gravitate towards a large capish sort of fund. And the SBI Quant Fund, in my opinion, is a proper large capish fund where most of the time 75% of the portfolio will be the top 100 companies in the universe. So it's a large cap fund where the hope is that regardless of the market regime, and this is key, regardless of whether one style is in vogue or another style is in vogue, this fund is supposed to do well. So I would argue that this is a core fund for most investors who essentially want a stable sort of fund as a core, and then on top of that you can add your bells and whistles. But this is a nice large cap fund where the endeavor is to beat the benchmark by a meaningful amount over any medium to long term time frame essentially.
Okay, so like a diversified, the same purpose that a diversified equity fund.
Yes,
serves in
diversified
your
large cap or large and mid cap type fund essentially.
All right, Dinesh, Sukanya, thank you very, very much for joining in, and we wish you all the very best for this fund. So thank you very much for watching. I hope this was helpful, and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.